What's going on, everyone? So we have some important news that I don't think is getting enough coverage that we're going to break down here. A long-awaited federal rule aimed at cracking down on freight brokers and freight forwarders who don't pay truck drivers is now officially in effect. So as of Friday, January 16th, 2026, a new FMCSA regulation known as the Freight Broker and Freight Forwarder Financial Responsibility Final Rule is finally enforceable. Now, this gives the FMCSA expanded authority to step in when brokers or freight forwarders fail to pay for services already performed. This new rule gives the FMCSA expanded authority to step in when brokers and freight forwarders fail to pay carriers for services already performed. And as we know, at its core, this rule targets a problem that carriers have complained about for years. People in the industry have talked about for years, is brokers withholding payment, forcing drivers to seek claims to go against their bond or go to file small lawsuits, small claims court, and they're taking that financial hit on while the brokers continuously move loads and are holding that capital. The FMCSA has been clear about its intent. The agency says most brokers operate with integrity and honor their contracts, but a small number of bad actors create serious financial hardship for motor carriers. Now, this rule is designed to give the FMCSA faster enforcement tools and provide carriers and owner-operators with more protection when payments stop coming in. One of the biggest changes is what happens when a broker's financial security falls below the required $75,000. Under the new rule, the FMCSA can immediately suspend a broker or a freight forwarder's operating authority if their bond or trust drops below that threshold and is not replenished within 7 calendar days. These shortfalls can happen for several reasons, including unpaid broker claims, a broker consenting to being drawn down on, failing to respond to valid claim notices, and also having like a claim converted to a federal court judgment. And if the broker doesn't fix the issue quickly, the FMCSA can just shut them down. The rule also tightens what counts as valid financial backing. Broker and freight forwarder trust funds must now consist of assets that are stable in value and can be liquidated within 7 days of a payment trigger. The goal is to prevent situations where carriers are told trust exists on paper but can't actually be accessed when the claim is filed. So there's going to be new responsibilities for surety and trust providers as well. If a surety or trustee becomes aware that a broker or freight forwarder is facing financial failure or insolvency, it must notify the FMCSA and initiate cancellation of their bond or trust. And then the FMCSA will publish a public notice of failure. If the broker later cures the default and restores the financial backing, the FMCSA can lift the suspension and update the record. The FMCSA also expanded its enforcement reach beyond brokers themselves. The rule gives the agency authority to suspend surety or trust fund providers under certain circumstances, adding another level of oversight to the system that supports broker financial responsibility. Another major change is who is allowed to provide trust funds. Loan and finance companies are no longer eligible to serve as trustees unless they obtain certification as a regulated financial institution. The FMCSA says those entities were not subject to the same federal or state oversight as banks or insurance companies, which created an added risk for carriers and owner-operators who are relying on companies and trusts like that. While this rule went into effect back in January of 2024, the FMCSA delayed enforcement until January of 2026 to give brokers, freight forwarders, and financial providers time to adapt and familiarize themselves with the new online registration system. But now enforcement has begun. And this isn't the end of the FMCSA's broker-focused agenda in 2026. The agency's long-awaited broker transparency rulemaking is expected to be published in May of this year. Now, what do you think? Does this rule create any meaningful change? Do you think this is actually going to impact brokers? We hear all the time that carriers think that the surety bonds should be much higher than $75,000. As a lot of you guys know, I come from a broker background, and I completely agree. I actually think that every year there should be some kind of review of the process of their surety bonds to see what that surety should be. I think the bigger the broker, the bigger the bond they should have. I don't think it should be this replenishing system that the FMCSA has decided to go towards. But again, this is, I think, at least a step forward where if they aren't meaningfully replenishing their bond back to 75,000, if they get hit for a $10,000 claim and they have to replenish that 10,000 pretty quickly within a 7-day period. So I do think this is a slight step forward, but I really wish that they would make it more of how big the brokerage is how big the surety bond needs to be. If you're moving $1 billion in freight a year, you should probably have a pretty big surety bond to make sure you're not going to hurt the carriers that are moving that freight for you. So what do you guys think? Does this FMCSA action create any meaningful change? Are you happy to see this being enforced? Do you think it should have gone further?